The Forex market never sleeps, but if you try to trade it at any random hour, your account will probably suffer for it. Think of it like walking into a small-town diner at 3 in the morning. The doors are open, but your options are limited, and the quality is questionable. Just because you can place a trade doesn't mean the price action is worth your time. The clearest example of this is the dead zone between the New York close and the Tokyo open. Traders call this window between 2100 and 2300 GMT the witching hour. This order book diagram shows exactly why that's dangerous. When the major global banks close their doors, volume vanishes. To compensate for that missing liquidity, brokers widen the spread, the gap between the buy and sell price. A normal 1 pip spread can suddenly stretch to 10 pips. Because that gap gets so wide, the ask price spikes upward. It hits your stop loss and closes your trade at a loss, even though the actual market value of the currency barely moved. You could have a flawlessly executed technical setup, but if you leave a trade completely unprotected during these transitions, your strategy will fail simply because you are playing in the wrong time zone. To avoid dead zones, treat the trading day like a continuous relay race. The baton starts here in the Asian session, from midnight to 09 GMT. As banks in Sydney and Tokyo wake up and open their doors, the market begins to slowly establish a rhythm for the day. Because massive institutional capital from Europe and the US is still asleep, total volume remains low. Most currency pairs drift sideways, consolidating in tight ranges. There is one notable exception to this low volatility. Commodity currencies, like the Australian and New Zealand dollars, along with the Japanese yen, dominate whatever volume is actually moving. This chart shows exactly how to approach these hours. Do not try to force a breakout. Instead, use this quiet period to map the high and low limits of the market's consolidation. The Asian session rarely offers explosive profit margins. What it does provide is the structural map, building the exact boundaries that European traders will use as targets when they log on. That map becomes vital as the sun rises over Europe. At 08 GMT, the London session officially begins. This is the true financial heavyweight of the morning. When London institutions enter the market, everything scales up instantly. To put it in perspective, roughly 40% of all global Forex transactions flow through this specific window. When London capital hits, volume surges, and the price aggressively shatters the tight constraints built during the Asian night. Professionals use the London breakout strategy, placing a buy trigger 5 pips above that range to catch the new institutional momentum. London provides the volume, but it also provides the direction. It dictates the true directional bias that the market will follow for the rest of the day. The absolute climax of the daily cycle hits a few hours later. Between 13 and 17 GMT, New York traders hit their desks, while London is still actively placing orders. Traders call this 4-hour window the golden hours. It is the peak of global liquidity, the exact moment when the financial engines of 2 major continents overlap. This massive injection of liquidity creates a direct mathematical benefit. Because the volume of trades is at its absolute maximum, broker spreads shrink down to their tightest possible margins. This split-screen chart shows the difference in action. On the left, you see the choppy, erratic 20-pip movements typical of low-volume hours. On the right, during the overlap, the market produces clean, highly predictable 60 to 80-pip directional runs. The billions of dollars flowing through the pipes right now iron out the noise. That sheer volume of institutional money dramatically stacks the mathematical probabilities in the retail trader's favor. This topographical map shows how you should actually view a 24-hour chart. You want to avoid the deep, dangerous valleys of the 2200 GMT transition entirely and aim your capital directly at the massive, high-probability mountains of the afternoon overlap. But even inside the overlap, you need to watch out for the 1530 GMT vacuum. Right around this time, London traders start going to lunch or closing out their daily positions. Entering a brand new trade blindly during this window is incredibly risky. That sudden exit of European liquidity often creates a sharp pullback, sending the price violently against the prevailing trend. Finding success in Forex means aligning your capital with the rhythm of the global banks. You map the boundaries when it's quiet, and you wait patiently for the major overlaps to reveal exactly where the big money is going. When you're ready to trade those high liquidity zones, take advantage of zero point 0.0 pip spreads and ultra-fast execution technology with FXNX.